One management call to another. We've got Mr. Puneet Dalmia, MD at Dalmia Cements, joining in to talk about how their business is shaping up, how they're reading the overall cement cycle at this juncture. Mr. Dalmia, thanks so much for joining us. Let me start with a bit of a macro question. Traditionally, I mean, we all know that this is supposed to be a bit of a patchy period due to the monsoons. But so far in the second quarter, how would you describe volume growth to begin with?
In the first quarter, we've seen very healthy volume growth of about 12%. In the second quarter also, past 2 months, we've seen volume growth of upwards of 10%. So I think the picture is not uniform all over India. The northern part of the country is doing very well. We've seen volume growth in Delhi, which is above 20%, largely due to the infrastructure spends which are coming through, like the Delhi Metro, the airport, and the Commonwealth Games construction. We have also seen rural demand picking up in UP and Madhya Pradesh, where demand growth has been in the teens. If you move on to the eastern part of the country, we've seen demand growth of high teens, which is 18 to 20%, which is due to the positive government policy in Bihar and a very strong state government in Orissa. In South India, the situation is a little bit mixed. In Tamil Nadu and Kerala, we have seen demand growth of about 8 to 12%. Tamil Nadu is 12, Kerala is 8. But in Andhra Pradesh and Karnataka, due to some uncertainty on how the IT sector will fare, the demand growth has been pretty flat. So Andhra Pradesh, I think, will pick up going forward because there is continuity of the Congress government now, and they had very strong projects on irrigation spending and low-cost housing. So I think Andhra Pradesh should pick up, but Karnataka, I would like to wait and watch as to how it shapes up. If we move on to the west, there have been infrastructure spending at the Mumbai airport and some ports in Gujarat, and also investments in roads and highways. So demand growth there is also looking up pretty well. Okay. So overall, I think I'm pretty comfortable with a 8 to 10% demand growth number in the country this year.
All right.
Yeah.
Okay, just wanted to get a sense for Dalmia in particular, how have realizations moved so far in the second quarter?
Realizations have been pretty much flat in the second quarter as compared to the first quarter. So prices have been stable in the second quarter, although there was a price correction in the first quarter of about 5 to 6 rupees in some of our markets, especially Andhra Pradesh and Karnataka, because there was very low demand growth there. So all in all, we are fairly comfortable with the realizations at the moment, although our cost structure has improved slightly because of coal prices coming down. Coal prices were at close to $180, $200 last year, and they've corrected significantly to just above 100 levels this year.
Sure.
So I think it has the realizations have been flat or slightly declining, but it has not caused significant margin pressure as of now.
Okay, Puneet, just quickly want to come to the aspect of capex. The report suggests that you're looking to build your capacities quite aggressively. What's the total capex requirement, and what channels are you looking at? And as I ask you this, I just want a word on the debt within the company. I think you have debt to the tune of 2,200 odd crores. Are you looking at reducing this? Go more on the equity line of things?
Right. Right now, the current snapshot of the company that you are seeing is, fully loaded debt. We took very little EBITDA from our new expansions because new expansions have just been commissioned. So we took a major capex of about 1,800 crores in Dalmia Cement and about 800 crores in OCL, where we have a strategic stake. So the total capex in the group in the last 2 years was about 2,500 crores. And it was largely funded through internal accruals and debt. So currently, the debt equity numbers are, slightly high. They are about 1.6 to 1 as compared to the industry. But if I look at our net debt to EBITDA numbers, they are fairly comfortable. Our sugar business is doing very well this year, and cement business is also ramping up in volumes, and profit growth should come in. However, as compared to the rest of the industry, our debt position is, higher. And that's largely due to our expansion plans. But we have managed the maturity of our debt fairly well. So we do not have much repayment pressure in the next 3 years. And I think my outlook on the industry is a little bit cautious. Next 2 years, I think we will face pricing pressure in the industry unless demand, growth outperforms significantly, more above than my 8% forecast. So I think we have managed maturity well. We don't have, pressure on liquidity at the moment. We also have about 350 crores of cash on the balance sheet as we speak right now. So the net debt is lower than what you just said. However, given our future expansion plans, I think we will need to raise capital at some point in time. But we would like to time the capital raising properly. And we are looking at all kinds of options at the moment. We have a range of options to consider. We can do a follow-on offering in Dalmia Cement if the stock we believe is fairly priced. Secondly, we can raise capital at our subsidiary level where we have a subsidiary which has incubated projects worth 10 million tons. And we can also fund our new projects through internal accruals over the next 3 years, depending upon how the cycle remains. So I think we have a range of options on the capital raising side, and we will examine all those options and come to a conclusion in the next 6 months.
All right. Good speaking with you, Puneet. Thanks so much for joining us on the show. That's a word coming in from Dalmia Cements.